Filing a tax return is not just about submitting forms. It is about accuracy and understanding how the IRS processes information. One of the biggest mistakes taxpayers make is filing before they have received all tax-related documents. Employers, banks, brokerage firms such as Robinhood, and government agencies send copies of income forms directly to the IRS. You are also supposed to receive these forms, such as W-2 from your employer and Form 1099 for interest and dividend from your banks and brokerage firms. If you file before those forms are issued or reported, your return may not match IRS records. When income does not match with IRS system, this often results in delayed refunds or follow-up letters. Waiting a short time can prevent a long delay. Another common mistake is assuming all income is taxable in the same way. Wages, interest, dividends, retirement income, and self-employment income are treated differently. Each type has separate reporting rules. For example, retirement income may be partially taxable. Social Security benefits may or may not be taxable at all, depending on total income. So that's why it is very important that you wait until you receive all your tax documents. The IRS compares reported income electronically. A difference of a few $100s can trigger a review. Another issue is misunderstanding dependents. Not every child or relative qualifies as a dependent. There are age rules, residency rules, sport rules, and relationship rules. Claiming someone who does not qualify can delay processing or result in repayment later. Let's say you claimed a dependent and you got extra money for that, so sometimes you have to return it back. It is important to review dependent rules every year, especially after life changes. Life changes affect taxes more than most people realize. Marriage, divorce, childbirth, relocation, retirement, and job changes all impact filing status and tax outcomes. It all depends on the circumstances. Using the wrong filing status can change tax liability significantly. Filing as single when married or head of household when not eligible creates problems, and IRS is very strict about it. Address and banking errors are another source of delay. If direct deposit information is incorrect, so then the IRS will mail you the check, which takes much longer. Taxpayers often overlook prior year carryovers, such as capital losses. You can only claim $3,000 every year. Missing these means paying more tax than necessary. Many people believe IRS letters always mean trouble. In reality, most letters are requests for clarification. That's it. Taxpayers should not ignore these letters. IRS notices have deadlines. Missing a deadline can remove appeals rights or increase penalties. So it's better to respond in a timely fashion. Normally it takes about 2 weeks for IRS to process the tax returns, but certain credits such as earned income tax credit, child tax credit require additional review. This does not mean something is wrong. If your refund is delayed, it does not mean something is wrong. Checking refund status too frequently does not speed up the process. IRS systems update periodically, not in the real time. So it's not like, it's every minute, every second is updating. No. Another misunderstanding involves tax withholding. How much tax is taken out of your paycheck every time you get paid from your employer. A large refund does not mean taxes were lower. Sometimes you get a lot of money back and you think, oh, your taxes have gone lower. No, mostly it means more was withheld during the year. So you are paying more. Some taxpayers intentionally over withhold to receive a refund. They don't want to see any surprises, or they have to pay so much money, so they just want to make sure that even if they don't get a refund, at least they don't have to pay too much. But mostly, people prefer accurate withholding, and smaller refunds, it's okay. Self-employed taxpayers face additional challenges. Income may not have withholding. Actually, when you are self-employed, there's no tax withholding mostly. You should be making estimated payments if you are self-employed to avoid interest and penalties, because if you owe IRS more than $1,000, you are supposed to make estimated payments. So failing to make estimated payments can result in penalties. Many people are unaware of this until filing time, and this happens a lot. And sometimes people just don't want to make estimated payments. They say, okay, we will see when time comes. Record keeping matters as well. Expenses must be supported with receipts. Bank statements alone may not be sufficient. This mostly relates to self-employment, people who are self-employed. Digital records, such as, you take the copies of the receipts or you scan receipts, they are acceptable as long as they are organized and readable, legit. Receipts should show date, amount, and purpose. You just cannot show a receipt, oh, here is the expense. It has to have a purpose, business purpose. Another common issue is misunderstanding extensions. That's the big one. An extension extends filing time, not the payment time. Tax payment is still due when the tax return is due, which is mostly April 15. A lot of people are misunderstood that, oh, we filed the extension, we don't have to pay, but that's not the case. Failing to pay by the deadline can result in interest and penalties. Actually, it does. Even if you're making partial payments, that can reduce your penalties. Sometimes you are not able to pay the full amount, at least whatever you can do. You should review your tax return for accuracy, such as name, dates of birth, social security numbers, and bank details. Signing a return means accepting responsibility. The taxpayer is responsibility for accuracy, even someone else prepared it for you. Most tax problems are preventable. They arise from rushing, guessing, or ignoring details. Slowing down, organizing documents, and understanding the process reduces stress. Happy tax filing. Thank you so much for watching. I will see you in the next one.